Hey, folks, welcome to InTheMoneyStocks.com's live trading action video. My name is Gareth Soloway, Chief Market Strategist here. Today's date is Monday, April 1st, 2019. We'll take a look at LYFT today, down about 10% on the day. This is just not a surprise to me. I mean, let's be honest. I mean, this stock had no way in hell it should have been trading north of 87 upon opening on Friday. It got above 88, close to 89, closed at 78. Today hit a low of 69. Now, it is coming off the lows, and I actually think it's going to move up. I am along a little with intraday stock chat members in this range. The idea here is very simple. So we're going to cover everything that has to do with the shadiness of this IPO and what's going to happen. And basically what I'm telling you is the price will get pushed back above 72, probably back to like 74, 75 until the Uber IPO comes out. And the whole idea here is it's all about reputation and getting more suckers in for Uber. So just looking at the performance of LYFT, right? Think about it logically. LYFT opens around 87, 88, collapses here. We're $10, almost $10 lower than that high. Insiders and those that got allotted shares, they got it at $72 a share. They're underwater already. Do you think everyone's going to be psyched to go out and get shares of Uber when it comes public? No, this is going to make people a little bit more nervous, obviously. The underwriters, they can't have that. So what they're going to do is, let's say there's 5 underwriters, they each got a $1 billion payout for bringing this thing public. And I'm just using arbitrary numbers. I don't know the exact amounts, but they're going to use some of that money to support LYFT and probably push it at least back above 72 to make things look a little bit better. And you can see it bottomed out around 69 today. It's already back to $70.65 here. My guess, again, it'll close above 71 today and probably be back above 72 by tomorrow. Now, average investors will just be like, oh, it's bouncing up. But smart money knows that underwriters are going to use some of that money that they got paid to support this thing until Uber comes out. Because all these underwriters, they're probably the same ones that are doing Uber, and they need to save face here because those people that are in high places at Uber are going to come to them and say, "Hey guys, we saw what happened to Lyft. We don't want that to happen. And if you're gonna say that this, if this is a possibility, we're not going to go with you guys." So again, there's a lot of stuff going on here, but ultimately, in my opinion, short term, they're going to support this price. Now, after Uber becomes public, I think Lyft goes down sub $50. Okay, now you might call me crazy for thinking that. I've seen this. I've seen the writing on the wall. I've seen this many times throughout my trading career where these underwriters and people will support the price for as long as they can. Because, again, it looks bad. I mean, it just flat out looks bad. I mean, think about this. At the open on Friday, when it was at 87, let's say, I mean, literally anyone who bought there, even if you sold 20 minutes later, you lost money, and you lost money, and you lost money, and you lost money. Today, if you're still in from Friday, you're down sizably. I mean, you're not happy. Like, literally no one who bought it when it became public made money on this thing at this point. Now, ultimately, I think we will because we'll see a little bit of a bounce here. But, I mean, we were smart enough to wait to buy it until it kind of bottomed out today. And again, me knowing how things work in the underwriting game and how they want to save face and make sure that it's not a fiasco. I don't know if you guys remember, but when Facebook came public and it collapsed, I mean, the underwriters literally had egg on their face, and it was not a pretty picture. I mean, there were a lot of questions asked about, how could you do this? How could you price it here? You guys stink. And then they probably lost future deals to bring companies public because of that. And these underwriters don't want to do that, folks. These big banks, these big institutions do not want to do that. And again, think of all the big institutions that got allotted 1 million shares, 2 million shares, whatever it was, and they gave it to their clients. Now they're calling the same underwriters saying, what the heck? All our guys lost money on this. What's going on? And so again, it just goes back to the idea that they'll probably support price in this range and probably push it back up. But once Uber comes public and they dump all these shares on the open market again, that's when my guess is they won't support LYFT anymore because they won't care as much. I mean, now it's a few weeks out or a month or two out whenever Uber comes public, and they won't care as much at that point in time. And in all fairness, LYFT, they're losing $1 billion here and there. Profitability is a long way away, in my opinion. This stock has no business in being up in this range. It should be sub 50, if not a little bit lower. Now, again, short term, as we're short term traders here at themoneystocks.com, we can make some money by buying it low and looking for the quick snapback and selling it and so forth. But it's a mess, folks. So, anyways, keep that in mind. I think that's very intriguing. Just a couple other things. Going to the spiders, for instance. Take a look at the spiders here, folks. The spiders are having a strong day. This is no surprise to me. I talked about this last night as a likely scenario because today is the first of the month, and this is the last thing I'll leave you with today. Understand that when you're in a bull run, so we saw it last month on the first trading day of the month. We saw it this month again on the first trading because the markets have been in a bull mode. So there's a lot of people rushing to get in. So the first of the month, there's more money that can flow into retirement accounts. There's more money that is released and can go into certain funds. So that first day, the institutions always push the futures up overnight, assuming you're in a bull run. Now, if the markets were collapsing, the money's not going to rush into the market. But right now, we're in this bull run. So what they do is they push the futures up, and let's say it costs them $5 million to push the futures up overnight. Then, when the market opens and all this money rushes in to buy stocks and buy stocks and portfolios, the markets will push up, but the institutions can unload into it. So it takes, let's say, $5 million to push the futures up 20, which is where they were at the open, and then they can unload 50 to 100 to 150 million into the buying that comes in for all these from all these retirement accounts and so forth at the first of the month. It's pretty classic. And again, it's if we had opened flat, they would have, they still could have unloaded to the buying volume, but they would have gotten a worse price. So it's very easy for them to, it costs them $5 million to push it up, let's say, and I'm using an arbitrary number there, but the idea is that they can then unload at a much higher price, easily making up that $5 million that it costs them, and unload way more and take more in profit. So it's a really no-brainer for them to push the futures up going into the first of the month, knowing that money flow from retail investors is going to be so strong on the first day of the month. Now, once the first day is over, a lot of that money's already in the market. It's not going to, flow in on the second and third and fourth and 10th day of the month. But this is a classic scenario. In fact, if you're still in a bull run come next, the last day of next month, probably smart to just buy a little bit and let this play out again. Now, if we start to have corrections and the markets aren't as strong and people get scared, you won't see that same inflow of money. But nonetheless, it is clearly in there today, and you can see it's a grind up. And again, this is all new money coming in. If the institutions weren't selling into it, we'd be much, much higher. You'd be vertical. This is just a slight incline, but you'd be much more vertical if there wasn't that institutional selling going on. In fact, we saw in the COT reports that big institutions actually got more short as of late last week. So my guess is, again, markets probably on borrowed time here, but they're still climbing. And again, interestingly enough, we have pushed above that 1 week ago high or so, and that'll be interesting to see where we close today. Okay. I did take about a 47% profit on BAC calls today with options alerts members, so nice job there for members. And again, we'll see what happens into the end of the day today. Have a great one, guys. Take care.